Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hang Lung Group Limited annual report. Hang Lung Group Limited is a diversified company that operates through various segments to provide a wide range of businesses and services. The company's primary focus is on property development and management, which includes developing properties for sale and lease such as retail, office, residential, and serviced apartments. In addition to property development, Hang Lung Group also operates hotels, shopping malls, office and industrial premises, residential premises, and car parking bays. This indicates that the company has a significant presence in the hospitality and commercial sectors. Furthermore, it offers various services including property management, financial services, apartment operation and management, property agency, hotel investment services, and property investment services for rental income. Overall, Hang Lung Group Limited's business operations can be summarized into several key areas: property development and sales, property leasing, hotels, shopping malls and commercial premises, residential properties, car parking bays, and various supporting services such as property management and financial services. Hang Lung Group Limited market capitalization of 21 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Hang Lung Group Limited holds a significant advantage in their industry. Hang Lung Group Limited trades at a higher price-to-earnings ratio of 15 times and a lower price-to-book ratio of 0.21 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.66%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in a company can be identified through an analysis of its financial statements and operational data. In terms of revenue growth, the key drivers include sales of completed properties, hotel revenue, increase in undrawn committed banking facilities, and increase in available balances of medium-term note program. These factors contribute to an overall revenue growth of $292 million, 11.6%, from 2024 to 2025. On the other hand, the primary drivers of revenue decline include rental income, which decreased by 8.6%, and property leasing revenue, which decreased by $1,092 million, minus 12.7%. These declines in revenue are significant and indicate a need for the company to reassess its business strategies and operations to mitigate these losses. In addition to these drivers, other key points worth noting include the company's diversified customer base, with no single customer or supplier accounting for more than 30% of total revenue. The company also has a significant increase in contract liabilities due to billing in advance of building management fees and other income from property leasing. Furthermore, the property leasing segment experienced a significant increase of 6.7%, while the Hong Kong sales revenue decreased by $127 million, minus 1.14%. The net income of the company experienced fluctuations between 2024 and 2025. On page 173, it increased by a significant 84% from $25 million in 2024 to $46 million in 2025. However, on pages 151 and 174, it decreased from $836 million to $454 million, and from $7,134 million to $6,972 million, respectively. Despite these decreases, the net income remained unchanged on page 204. The profit margins of the company also underwent changes between 2024 and 2025. On page 150, the operating profit margin was 25%, while the profit before tax margin was 22%, and the net profit margin was 18%. However, on page 151, the operating profit margin decreased from 43.1% to 41.3%, and the net profit margin decreased from 19.9% to 16.3%. The improvement in profit margins on page 173 was attributed to a decrease in net interest expense. Conversely, on page 174, it decreased due to increased staff costs, lower rental and related income, and higher depreciation. Additionally, on page 181, the profit margin for investment properties under development decreased due to higher estimated development costs and market requirements. The company's operating cash flow has been steadily increasing over the past 2 years. In 2024, the company generated an operating cash flow of HK $5,215 million, which rose to HK $6,062 million in 2025. This significant increase indicates a strong financial performance and ability to generate positive cash flows from its core operations. The company's debt level has undergone significant fluctuations over the past year. While there are instances where the total debt level has decreased, such as from HK $57,794 million to HK $54,837 million. Other sections indicate an increase in bank loans and other borrowings from HK $35,956 million to HK $37,638 million. The debt-to-equity ratio also shows a decrease from 37.9% in 2024 to 35.3% in 2025. Interest expenses have shown mixed results as well. Some sections indicate a decrease in interest expenses on bank loans and other borrowings from HK $1,016 million to HK $1,832 million. However, other instances show an increase in interest expenses due to a 100 basis point increase in market interest rates, resulting in an estimated annual net interest payment increase of HK $158 million. Overall, the company's debt level and interest expenses have not changed significantly in a consistent manner throughout the summaries provided. The performance of various regions and segments in the market has been mixed. In terms of poor performers, the Chinese mainland saw a significant decline of 7% in office portfolio revenue. Hong Kong also struggled, with the retail sector experiencing a 4% drop in rental revenue and the office sector witnessing a 2% decrease in segment revenue. Additionally, Shanghai faced challenges due to an oversupply of space and subdued demand. On the other hand, some segments showed relatively strong performance. The retail sector saw a 1% increase in overall rental revenue from mall portfolios, as well as a notable 4% year-on-year increase in tenant sales. This suggests that despite the challenges faced by certain regions, there are still areas where businesses are thriving. Management is emphasizing the company's commitment to sustainable growth, with a focus on enhancing sustainability initiatives in the real estate industry. The company is transitioning into version 3, V3, a strategic framework that involves highly selected investments and leveraging existing assets in core cities to drive long-term values. A key aspect of V3 is investing in asset-light business lines that will increase presence in core cities and have a lasting impact on the future business. Management is also focusing on improving durable recurring revenues, reducing leverage, managing costs, and building a resilient organization. To achieve sustainable growth, management has outlined 5 overarching strategies: being customer-centric, building Hang Lung branded experience, embracing technology, disciplined execution, and upholding Hang Lung values. These strategies are expected to drive growth through prudent pricing, phased releases, and superior product quality for property sales. Management is also committed to leveraging shifts towards value-driven spending and experiential placemaking for growth, as well as elevating the 66 brand through marketing initiatives across mainland portfolio. Strategic partnerships with local property owners supported by government initiatives are also expected to contribute to rental growth support from various expansion initiatives. Overall, management is confident that these strategies will drive sustainable growth and strengthen communities while enriching lives. The company has made several strategic moves through acquisitions and divestitures to optimize its portfolio. On the acquisition front, two notable deals were made in China and Hong Kong. In the Chinese mainland, the company acquired Hangout, while in Hong Kong, it acquired Network. On the other hand, the company has also been actively divesting certain assets to streamline its operations. This includes the exit of tenants from physical fitness centers, which is a significant move towards reducing operational costs and focus on core businesses. Additionally, the company is engaged in an ongoing sell-down of completed residential properties, further demonstrating its commitment to optimizing its portfolio and allocating resources more efficiently. The company has a history of paying dividends to its shareholders. In the past year, the total dividend per share was HK$0.36, which is consistent with the previous year's payout. The company also paid out a significant amount in dividends, totaling HK$171 million for both 2024 and 2025. This indicates that the company has prioritized returning value to its shareholders through dividend payments. The payment of dividends suggests that the company has generated sufficient profits to distribute some of them back to its investors. The consistency of the dividend payout from one year to another also implies a stable financial performance by the company. Overall, the company's decision to pay dividends demonstrates its commitment to rewarding its shareholders and providing them with a return on their investment. That concludes the financial summary for Hang Lung Group Limited. Feel free to comment below, and I will be happy to answer them when possible.